All right, let's talk about S corporations for real estate agents. If you look at a lot of TikTok videos for real estate agents, you're going to see them telling everybody, every single agent, you should be an S corporation. And while that can be good advice for a lot of real estate agents, it's not necessarily blanket advice that applies to everybody. So I want to break it down for you for just a minute. What exactly is an S corporation? Well, as we all know, real estate agents are considered self-employed. You don't have an employer. While you might work for a specific brokerage and you might be on a certain team, at the end of the day, you're a self-employed individual. And as a self-employed individual, your default income tax status is to file as a sole proprietor, as a self-employed individual on Schedule C as a part of your personal income tax filings. Now, what happens as a Schedule C filer is all of your net profit, that's your gross income, your gross commission income minus all of your expenses equals your net profit. That net profit is going to be taxed in two different ways. The first way is going to be taxed with self-employment tax. It's going to be just over 15%. You're going to pay self-employment tax as a self-employed individual. So if you make $10,000 of net profit, you're going to have a 15% self-employment tax right off the top. So it's $1,500, give or take, right? And then in addition to that, the second tax that you're going to pay is the ordinary income tax. That's the income tax that you would pay if you were not a self-employed individual, but you were working for another company as a W-2 employee. Now, those tax rates are gonna vary. It could be as low as 0 if you make very little money. It could be as high as 35+%. So let's just say hypothetically, you're in the 15% tax bracket. So in addition to your 15% self-employment tax, you're gonna have a 15% ordinary income tax. So you're gonna have 30% of total taxes that are gonna be due on your net profit. That's what you're faced with as the default taxing mechanism as a self-employed individual. Now, you've heard this idea of S corporation. What does it mean to be an S corporation? Well, the first thing you have to do as an S corporation is you set up an entity. So typically it's an LLC, but you can talk to an attorney and they can advise you whether you need to be a corporation or an LLC, depending on what state you are in and the laws and blah, blah, blah. But the reality is you'll become some sort of an entity. Usually it's an LLC. So you become an LLC. You start having all of your business activities running through that LLC. Now that LLC then, what it does is that LLC elects what we call S corporation tax status. The corporation part of it is a little bit confusing. It doesn't mean that you're an actual corporation. It just means you're taxed under subsection S of the Internal Revenue Code. You become an S corporation. Now, what that does is that pulls your income off of your personal return and it puts it onto a separate business tax return. Now, that business tax return looks a little bit like, although it's different, but it looks a little bit like, and it functions like that Schedule C on your personal tax return. You have your gross commission income at the top, you've got all of your expenses, and you've got your net profit. But here's the difference with an S corporation. That net profit then goes from that S corporation and it flows all the way over to your personal tax return, and you pay ordinary income tax on that net profit. And you could say, well, that's all well and good. If I only have to pay ordinary income tax, I save the 15% self-employment tax, right? Well, yes and no. You do pay only the ordinary income tax. That's the tax savings. However, as an S corporation, you've got certain requirements that the IRS requires you to follow. The primary one that we're concerned about on this video is that you have to pay yourself, an officer of the corporation, you have to pay yourself a quote, reasonable salary. What's a reasonable salary? Well, it's hard to know. The IRS doesn't really define it. We can use some mechanisms to try to figure that out. But let's just say for argument's sake that you make $100,000 in your business. And let's just say for argument's sake, we've considered that a reasonable salary for your S corporation is $40,000. So what you do as an S corporation is you pay yourself as an employee of your own S corporation, you pay yourself a salary of $40,000. Now that salary is subject to Social Security and Medicare tax. And as the employer, you have to pay both sides of that. And so at the end of the day, you end up paying what we would call the self-employment tax, that 15%. You end up paying that 15% onto the portion of the profit that we consider to be the reasonable compensation, the reasonable salary. You're going to pay that 15% on that $40,000. The difference, the remainder, that $60,000 of profit, however, is not subject to self-employment tax. It goes onto your personal return. and it's just taxed at ordinary income tax rates. And so in our example, if you had $100,000 as a self-employed individual on your personal tax return, you would pay $15,000 in self-employment tax and $15,000 in ordinary income tax. However, as an S corporation, if we said $40,000 is the reasonable salary, you would pay basically the whole 30% on $40,000, but you're only going to pay 15% on the other $60,000. So in a sense, you're saving 15% of that $60,000. If we do quick math on that, it's about $9,000. So you can see quickly that there can be substantial tax savings to becoming an S corporation. So to go back to our question, should everyone become an S corporation? Well, maybe, because there are certainly tax benefits to doing so. However, there are also some additional complications, some additional costs. So the first one we already talked about is the fact that you have to pay a reasonable compensation. Now, how are we paying reasonable compensation? Well, you're probably going to end up using some sort of a payroll service. There's large companies like Paychex and ADP. You can do it yourself using Gusto or QuickBooks Online Payroll. There's different options, but regardless of the option that you choose, you're going to have payroll processing costs that you're going to have to deal with, because you got to make paychecks, make a direct deposit to yourself. Maybe you got to file quarterly forms. You got to file annual forms. You got to file W-2s, and the list goes on and on and on. So you got a cost associated with doing that. In addition, you have a cost associated with filing a separate income tax return. Because remember, we're pulling the income off of the Schedule C and putting it onto a separate tax return. Well, an accountant is going to charge you to do a business tax return. It's a separate tax return, and it's a little bit more complex than your personal return. So all of a sudden, we've got multiple income tax returns going, and your accountant's going to be charging you to do that. And so you can see right off the bat that there are additional costs. So it's not just all free money by electing S corporation status. You're going to have additional costs that go along with becoming an S corporation. Now, in addition to that, we also have this idea going back to this concept of reasonable salary. What is reasonable salary in the eyes of the IRS? Well, the IRS gives us a lot of kind of wiggle room. There's a lot of leeway. It's a gray area. However, if you make less than $50,000 as an agent and this is your full-time job, it's really hard for us to make a solid argument that all of that money should not be considered reasonable compensation. And if the entire amount is reasonable compensation, then there's no point to be an S corporation. And so you can quickly see that if your income is going to be under, if your net income and your net profit is going to be under about $50,000, then there likely is not going to be any reason for you to elect S corporation status if you want to treat reasonable compensation appropriately and to potentially avoid some IRS risk there. And so where is the line? Typically at the agent's accountant, once a real estate agent has a net profit over $50,000, somewhere between $50,000 and $100,000, we begin to have the conversation. We begin to run the numbers to say, can we pay a reasonable compensation, cover the additional tax preparation fees, cover our payroll processing fees? Can we do that and still save enough to make it worthwhile? And we do tend to find it somewhere in that $50,000 to $100,000 range. However, it is going to vary depending on the client, their situation, their circumstance, the other things that they have going on their personal income tax return. It can be a complex calculation, but it can be a significant way for agents to save money. We look at this for all of our real estate agent clients. If you're interested in that or other tax planning advice and strategies that we use at the Agent's Accountant, we'd love to have a conversation. Just go to agentsaccountant.com and click on the contact page. We'd love to schedule a call with you to walk through how we at the Agent's Accountant can help you to build wealth and save tax dollars.